Hey everyone, today we're speaking to Arjun Arikeri, who's a principal at Multiples Asset Management. He primarily covers the financial services sector, and both me and Aman have had the good pleasure of working with Arjun over the last few years. So, Arjun, thanks for taking the time out to speak to us.
No, not at all. Thanks for having me on this.
Yeah. So, you initially did your undergrad at IIT and then went on to do your MBA at IIM. So I think our first question was just more along the lines of like, what was your thought process in terms of working post your undergrad versus sort of doing an MBA right after that? So how did you go about making that decision?
Sure. Back in those days, I would say there wasn't really a lot of deep thought process, but you just saw what your seniors were doing and tried to take cues from that. Honestly, after undergrad, the option was between either going to the US for an MBA or to the US for a master's, or staying back in India and doing an MBA. And I was fortunate that I got into one of the best B schools, and then I did look up what a lot of my seniors were doing. It was quite exciting, and I jumped into it, not really knowing what things would be like. That was it, to be honest.
Got it. And just that, IIM wanted to get a sense of how did you think about getting into finance, and then how did you go about narrowing down whether it was an internship choice or your final placement choice on like which subsector particularly you wanted to focus on?
Yeah, I think once I got into IIMA and started doing the courses, things got a little clearer. You understood what it is. Finance was seemingly a little more quantitative, and that was the reason why there was an inclination to do finance. But in the early days, I interned with an investment bank, and that's when I learned what banking is about. While it was very exciting from the outside, when I was getting to do it, I somehow felt that this is probably not something that is best suited for me. It is, of course, very difficult business to do. You need to really win the trust of both sides in terms of entrepreneurs and investors, and make ends meet, and getting transactions done is not an easy job. But that said, I was craving for something a little more deeper, a little more involved, a little more engaged. And then somehow I took to finance, and corporate finance looked more appealing. And I was, clear in my mind that I wanted to do something related to corporate finance, and private equity ends up being pretty close to it.
Got it. Yeah. And when you think about like your journey on how you transitioned eventually to private equity, what was the process like and how did you go about it? So you started at ICRA and then you kind of moved to public markets, explored that for a bit, and then finally moved to private side of things. So just that journey on what you picked up at each stage, and how did that help you kind of get a more clearer path to what you want to do next?
Right. So ICRA was a bit of an unusual choice in the sense that it was also 2009, not necessarily the greatest year to get out of college. But in hindsight, it was probably the best place to start, because ICRA is so cut off from capital markets that, unlike a lot of people that I've seen who graduated after my batch, who straight away jump into very capital marketsy stuff, which is trying to form views on companies with whatever is already written about them. ICRA is a place where you actually start from the annual reports of companies, and you actually start, in my first project, I was actually keying in numbers from an annual report, trying to tally cash flows of a company which had 8 real estate projects. And I thought I learned real stuff there. I really thought when I formed a view on a company, it was my view based on all the work that I had done. And from there on, my first choice was to a family office which did a lot of public market investing. I was fortunate to really get that break, to move from the credit side to the private equity side. And that really happened because while we were doing a lot of good work in ICRA, I did feel that we were not really using the amount of knowledge that was there to do more with it. You just, gave a rating, and then you sat back and watched how things happened. So this opportunity, when it came up, I just grabbed it with both hands. I was, like I said, I was fortunate to get that break. Public markets was very exciting because the breadth of what you do there is phenomenal. The feedback that the market gives you is real time, so you don't get to hide a lot. But at the same time, while we were doing it, like I said, at the very beginning, I was craving for something a little more real, little more deeper. And that's when I got the break into multiples back in 2013. And my excitement was to do a lot more private market stuff and at least see what private markets is like, what private equity is like. And it's proven to be something that I think I like the most and I like to do for the rest of my life.
Right. I think something you've always mentioned is the fact that the public markets experience taught you a lot of things that perhaps would have been much more difficult to pick up by jumping straight into private equity. So maybe if you could just throw a little bit more light on like some of those aspects.
Yeah, sure. So at least in the initial days of private equity, after I moved from my public market stint, I felt that in a private equity job, you're a lot more prepared. In a public market job, you're a lot more prepared because you never know which opportunity comes your way, right? There could be a interest rate reversal and suddenly all the banks have started trading way below what they were doing a few years ago, and you had to act at that point in time. There was some policy change in some industry and suddenly you had opportunities in that industry. So that way you're a lot more agile, ready to act across different sectors, and the breadth of what you cover is also wide because you can invest in, at least in the job that I was in, it was a family office, so I could have bought a HDFC bank or I could have bought a City Union Bank. It didn't matter. And so to that extent, you were really comparing and contrasting everyone that is there in the market and trying to see who's the best out there. And so the entire world was there for you to really form a view. Whereas when I came to public markets in the initial days, at least the way back then things worked were you would get a transaction opportunity in some space and then you would deep dive into that space after it comes your way. So that way, while both are very different, public market just keeps your view a lot more broader, I would say. And I've seen that with the couple of people we've hired subsequently into multiples. People who come from the public market have that different aptitude. They are really comparing a breadth of things. It may not even be all companies from the same sector. Whereas in private markets, you do, because you spend so much time at depth in a particular situation, you sometimes can lose the broader picture and the broader view of what other opportunities are there to deploy your capital.
Right.
Got it. And just also contrasting some of the investment themes or the investment styles that you worked across. So you've done a fair bit of growth equity that you largely focus on in multiples, and you've also had a chance to kind of spend some time on special situations. So how do you contrast the two, and what are the skills that you need or the jobs that you need to develop to navigate both of those strategies?
Sure. Yeah, growth equity is very exciting, right? And it's a very difficult job because not a lot of companies grow and break out to be successful. And identifying some of those qualities within companies that make them successful is a difficult skill. While at the same time, if you look at investing across more developed markets, I think each class of investing has so much depth that you could do a lot of transactions. And so special situations was an opportunity like that. I was very excited when I got that opportunity, when I saw some of the transactions that my erstwhile firm KKR had done in the US and Europe and Australia in distressed assets and taking them over and turning them around. It's a business which requires you to keep track of every single rupee. It's a business where you learn a lot more about the balance sheet, about capital structure, managing your debt, day-to-day operations, where all of those things are very important. Not that it's not important in growth private equity, but because a lot of these companies are well-funded and their number one focus is to just grow, these things do take somewhat of a second priority in growth equity. But in special situations, you can't survive without it very often. And so therefore, you need to have so much more focus on the cap structure. Every discussion actually there starts with the capital structure first, right? So just different areas in which you emphasize more in both the businesses.
Right. And I think, did you manage to also see some bit of like credit type deals as well during your time in special situations? Has a lot of that experience also translated into private equity in the sort of the way that you approach deals in any way?
Yes and no. The special sits mandate was more to achieve equity-like returns, but with a credit-like protection, if I were to call it. So that is, you have loan structures which potentially can convert into equity, or you have equity which is senior to the equity of some of the others who are already in the company because you are coming late and coming at a time of distress and trying to turn the company around. So it just taught you so many more layers in the capital structure that can get created, right? And so many more ways to find solutions, which is essential even in growth private equity, but a lot lesser. Most of growth private equity deals tend to be plain vanilla equity deals, but there is just so many other ways you can solution situations. And I think that was the number one point of special sits. You could offer a company 3 different valuations, depending on whether you are coming in as equity or you are coming in as pari passu debt, or whether you're coming in as senior debt in the company, right? So that was a complete new way of thinking that I learned. Whereas most often in growth equity, this is the valuation. Are you there or are you not there, right? So that was definitely exciting. One of the key things that I also learned in special sits is that there is a downside case and there is an upside case, right? And most of the things in between that don't matter. And that's probably true of growth private equity too. Very often we model and we try to like move things around the mid case. But what really matters is just the downside case and the upside case.
Right.
And I think, we've also spent some time looking at, a fair amount of buyout deals, I would say, maybe mid-market buyouts. And so how does that play in? Does it have like a characteristics which are more similar to special sits because you are the controlling shareholder and you have a lot more cadence to what can be done and implemented? So how do you approach those situations when you kind of evaluate those type of deals?
Yeah, somewhat similar, Aman, because typically when you do a buyout, you do try and put some leverage on the capital structure because you can't really, these happen to be well-known companies because they're well discovered. It's very hard to make the kind of returns that you're trying to make. Even otherwise, you are trying to juice out some additional returns. So you do put some additional debt out there, and that does bring some element of additional discipline in terms of tracking the cash flows. But the big difference is that typically in special sits, you're trying to turn something around, right? And that was the most complex part where, again, I think India differed a lot from the more developed economies, where at least, for my European counterparts or the American counterparts, there were a lot more players in the ecosystem who supported such activities and you could manage them a little better. I think those aspects are harder to do in India. Whereas in buyout deals, while you're trying to take good to great, you're not really turning things around. And so in special sits, sometimes survival can take up all your time. Whereas in buyouts, typically you survive. You may not make a great return, but if you do well, you do make a great return. So those are the aspects of, that differ between the two. But you're right. In some of the buyouts, you do have a similar focus. A lot of your returns comes from the cash accretion that's happening along with the growth.
Right. And just on like the growth equity segment as well, which you spent a lot of time on, in what particular aspects would you say it's very different from like venture capital in terms of particularly the way you are approaching or analyzing a deal? And so from that point of view.
I would just say it's just the point of time at which you jump in. As a venture capital, I think, both of us are tracking industries, right? I can take the example of financial services. So financial services, for example, you could believe in something being better done direct to customer than through an intermediated way. While as a venture capital, it makes all the sense to then go ahead and back a few opportunities because I think their model also allows them to have a couple of failures without impacting the overall returns because whatever succeeds for them ends up being a big hitter. Whereas in private equity, you would want to see some proof of concept, some success over a few cycles for a particular player, and then be able to extrapolate it. And the risk you want to take is the fact that this will now grow. You typically don't want to take a risk of something that has not had the proof of concept.
Yeah.
So I think those are the differences mainly. And so while our venture capital friends may fund 10 such businesses, we would then probably filter out and look at the 3 or 4 such businesses which have managed to get past the initial hurdle and have demonstrated something which we can then extrapolate. But equally, you've seen transactions that we've done. We've incubated companies here, of course, not in new businesses, but in traditional businesses. I think there will be areas where the two will merge, just given the quantum of capital that's coming in, the size of deals that venture capital is doing, the kind of opportunities that growth private equity has missed out on. I think the two will probably overlap with each other a lot in the time to come.
Yeah.
Got it. One other interesting aspect that we wanted to kind of touch base on is like this new trend of a lot of operators turning into VCs or investors, and generally your view on how important it is to have operators when you're making investment decisions, and how do you really contrast being a financial investor versus being an operator? And over time, a lot of operators kind of also trying to dabble into investing. So just the dynamic on how you see it grow.
So when you say operators, can you give me a few examples of who you're referring to?
Yeah. So for example, if you take the Flipkart founders, some of them have got into investing. Right. And then I think recently, some of the earlier fintech founder groups, they have been doing active angel, but now they're also kind of taking it a step further and maybe setting up a VC fund to kind of give back to the ecosystem and get into maybe slightly more earlier stage investing.
Right.
But those kind of examples. And I think probably in the Western markets, a lot of CEOs, etc., also have sometimes joined, VC funds or even senior private equity roles. So just that aspect.
At least I have always benefited from having someone in the industry. I think it's a double-edged sword. While sometimes it helps you, but there are also times when people who have seen it being done one way have not been believers that it can be done any other way. I think the perfect example here would be the delivery deal. Back in those days when we were underwriting the deal, we did speak to a lot of people from the industry, and it was express logistics was a age-old industry, and a lot of them felt that it's not an easy business, and a new company that's starting up, young bunch of guys who've not done it before, or the way this is being done, it's not going to have a lot of legs. So I think it's, the way I've always thought of it is use the people who are from the industry for facts. They are the best placed in terms of telling you the facts, giving you the benchmarks on what a certain parameter should be, what a certain metric should be. For example, in a lending business for a particular segment, particular geography, or for any kind of a cut, what should one expect in terms of IRRs, in terms of loss ratios, in terms of other parameters on bounce rates and so on. I think from a fact standpoint, there is just a ton of value that you get from speaking to operators. But it's always best to just form your views based on first principles. And also as a investor, you do get to meet a lot of companies in the same space before you have to invest in one. And a lot of your learning also happens from speaking to a lot of these companies. With respect to some of the younger, not the younger, some of the experienced investors or some of the experienced CEOs and ex-entrepreneurs getting into investing on their own, I think they've had a great track record, it seems like. One of the reasons is because a lot of the disruption that's happening doesn't have to do with a particular sector or a space. It actually has the experience of a particular sector, but then there's a common theme around it, right? For example, direct to customer. It's working as much in cosmetics as it is working in financial products. And so that's where someone who's probably done a lot of digital marketing or customer acquisition through different channels is helpful for both the businesses as much. And I think that common thread continues to remain today. You're seeing a lot of such disruption, and so it's super valuable to have somebody who's done it before in a market, because no matter how much you dig into the financial services world and traditional financial services, you will not find someone like founder of an e-commerce company to tell you what it takes to build a direct to customer brand and a direct to customer business that is scaling.
Yeah. And just like following on from that, I think one thing you've probably mentioned before is also that while PE professionals have a really good understanding of a lot of aspects and a really broad view of sectors and all of that, maybe one of the things they might be missing slightly is some sort of like insights that comes from having operating experience. Is there any way that PE professionals can go about like filling that gap for themselves and therefore just like improve the way they go about analyzing deals with those insights?
Sure. One of the things I'd seen with the early stage venture capital firm is some of the junior folks I know there, they actually work out of the portfolio company offices on a couple of days a week. I thought that's a phenomenal thing to do. One of my previous jobs where we had a buyout deal, I actually spent a couple of days a week at the portfolio company, right? I think over a period of time, as you spend time in the industry, there are transactions that you will do where you will have that kind of a relationship where you could just, if you have a chance, just go and spend one day a week at that company, not necessarily doing or working on that asset itself, but you could do what you're otherwise doing, but just spend time there. There is just no substitute to spending time in a non-evaluative scenario or situation at a particular place, right? Because otherwise, when you're there only for a meeting or for a visit or for an evaluation, everything is kind of prepared. The other party also has their antennas up, and so it's not a completely unguarded conversation. But if you're able to, get into a scenario like this, there's just no substitute for it. So early in your life, when you can afford to do that, I think there's a lot of merit in doing that. That's one thing that I can think of readily.
Yeah.
Got it. Yeah. And just, I think towards the end of this segment, one thing we wanted to pick your brains on is, what are a couple of aspects that you would say you have enjoyed the most in your last decade, almost last decade in private equity, and also a couple of things that you would highlight that, potential candidates should be wary of as they think about this as a long-term career choice.
Sure. What I've enjoyed the most, it may just sound a little too nerdy and too minor a point, but for me, the aspect that I like the most is when I project something or estimate something and then things come out like fairly close to it. That's of course a feel-good feeling, but equally when things don't come true, but then at least you're able to see and track what you said versus what you've done. I think that's the best part of this job. And personally, I go back and keep track of everything that has been happening for the last 10 years. So I have this habit of just putting up a Google Calendar invite for any big major macro forecast that anybody does, or any big transaction that I personally look at, and try and see what happens a few years out. Thing with this job is you get to see that, right? And you get to see the impact of it. And what you realize is that you're either right and the outcome is like way better than what you thought, or you're wrong and the outcome is like pretty poor. You never really end up at the median case that you put in your notes, right, as a base case that you let. But that was, of course, a smaller point. But the bigger thing that you enjoy is really the fact that you kind of become partners with the entrepreneur, and you realize that they are actually going through the same kind of thought process that you are, right? In the early days, I used to think that these people know everything and they are like demigods who have the answers for everything. But as you partner and get to know entrepreneurs, you realize that they have the same questions, same doubts. They go through a decision-making process. And the most fulfilling part is when they think they can actually ask you or rely on you or seek your input out on what they should do. I think those are some of the most difficult circumstances, because then you need to really apply yourselves and come up with something that is really meaningful, but at the same time, it's very fulfilling. Sorry, you did ask me second part to the question, right? Which was what people should be careful of.
Yeah, just generally of candidates who are kind of aspiring to be in private equity longer term, what are maybe like two things that you would advise that they should maybe evaluate for themselves, or things to kind of look out for as somebody thinks about it in the medium to long term?
Sure. So I think a couple of things. Number one, this is a long gestation business, and sectors go through ups and downs. The private equity industry itself has seen periods of strong flow, weak flows, weak exits, strong exits, and so on. And so it takes a good 10 years, 12 years for you to even see one full cycle, I would say. Personally, for me, having graduated in 2009, having made the decision to do my MBA in 2007, and having seen what is happening post-COVID, has probably been one full cycle, right? So you really then, it changes your point of view. Sometimes just which point of cycle you started probably sets your mind in a certain manner. A lot of people tell me that because they graduated in 2001, they think very pessimistically, or because they've graduated in 2005-7, they just feel that the world is always going to keep going up like a rocket ship, right? So those are some of the things that people need to keep in mind. It's always good to take a step back and know that cycles come and go, and a lot of what you achieve is probably also a function of where in the cycle you are. That's one. Secondly, this is also an industry where you need to think of what you will do 20, 30 years out and start preparing for it. It's an industry which does get a little narrow at the top. And that's because it should be a narrow at the top, in my view as well, because it's not a democratic industry, right? And as you spend time in the industry and build confidence on your own decision making, you would also want to start making some of the decisions. But the key to actually running a business in this industry is raising capital. And raising capital is not an easy task at all. And so I think it'll be helpful for people to give a lot of thought on what their aptitude is. Are they suited for this industry? And before they jump into it.
Yeah. Got it. Yeah. So I just one quick follow-up on that piece. So this advice and the skills that people have when they are, say, like at the junior level as an analyst associate, to a mid-level where maybe they are AVPs, VPs, and then as you kind of go on, is this a question that people should evaluate for themselves every 3 to 5 years? Because the skills and the expectations and what you bring to a deal as an individual kind of is pretty dynamic. And I guess ultimately it all culminates to you being able to raise capital for the fund. So is it something that you keep evaluating to see, if you are cut out for the next level? Because like it's pretty overwhelming to kind of think about it today to say, like, will you make it in 20 years time?
100%. I totally agree. And you change as a person as well, right? When you are 10 years in your industry, you end up doing things that you wouldn't have imagined you can do 10 years out. So I completely agree, Aman. I think it's something for you to evaluate at each stage in your career. I think early in your career, you do get a lot of opportunities to, change tracks, move around, and so on. In my view, I think this is an industry that everybody who has the opportunity to give it a shot should give it a shot, because it's probably the most fulfilling one. But yes, as you go along, you can keep some of these aspects in mind on the peculiarities of the industry itself.
The last segment was super helpful, just traversing through your journey and looking at things from your vantage point. But as we move on to the next segment, I think we just want to focus on some of the advice that you would give to aspirants and folks in the industry who are early on in their career. So just to kick that off, I think one thing we wanted to check with you was that for somebody who is still in their undergrad stage and are thinking about a career in finance, how would you advise them, or how should they think about an MBA today? Like, should they kind of try and get some work experience in the industry and then kind of think about it? Or do you think like just getting an MBA out of the way gives you a longer runway to then explore different options?
Yeah, I honestly don't know which is better, Aman, but I would certainly advise people to think of MBA very positively. The reason is, in my own case, when I look back, and I think of all the people that graduated along with me in college, and I think of the kind of bond and relationship I have with them, there is no way it could have been recreated in any other way through professional relationships. So there is a special relationship you enjoy, and you build a huge network. In my own batch, I can name it, but there are over half a dozen people who are senior professionals in private equity. There are a lot of founders from my batch. There are a lot of people who are in very senior positions in corporates from my batch. So that kind of a network and relationship is unmatched. As far as WorkX or no WorkX is concerned, I would tend to believe that at least some WorkX is good. And that's also because when I look back and see a lot of things that I learned in class, a lot of those things actually made sense to me when I started working. And I would just look back and think about those aspects. So not that they were lost on me just because I started afresh, but maybe with a few years of work experience, I would have been a much better contributor as well back in my B school. So that's my belief. But I went straight from undergrad to MBA and then started working. Yeah.
And sort of just in terms of like the traditional paths for someone to get into private equity, we've usually seen it mainly being either banking or consulting, depending on the funds. If you could just throw more light on why are those the preferred fields, and which of the two perhaps do you see as the more traditional route? Yeah.
Sure. So firstly, why banking or consulting? And so if not banking and consulting, then what else? I would think probably the reason is because most of the guys who end up doing very well academically end up in either banking or consulting. And that's potentially the reason why we end up hiring from there. Within those, I think, at least in my personal experience, there's been a slight bias towards people who've been from a banking background as opposed to consulting. And I don't think there should be a strong reason for it, except the fact that as a banker, you spend a lot more time on just the financial aspects of the business. There's just a lot better understanding of the money and capital efficiency and returns and valuations. Whereas as a consultant, at least in the early stages, what I've seen with people is that they deep dive into one particular aspect of a business. And until you're a little senior, you don't probably end up getting the full view of the business. For example, somebody is in some steel plant optimizing for one particular leg of the supply chain and does a complete deep dive on it, but may not necessarily have understood the full implications of it in terms of the return profile or the valuation of the company. And yeah, we've just found that some of the banking candidates are a lot faster and easier and seamless in terms of their hard skills. That's something that is a hygiene factor if you want to start off. So I've personally seen that difference between the two category of candidates for sure.
Right. Yeah. And what can people from maybe backgrounds other than this, like banking, consulting, what can they do to perhaps give themselves a better shot of competing for private equity roles? Like, for example, people who have worked in due diligence.
Yeah.
And yeah.
I think some of the guys we've seen working in due diligence have phenomenal exposure. They look at a lot of opportunities. They look at it very closely. They look at it with a similar lens as a private equity would do. And there's no reason why they should not really fit into a private equity role really well. I think what else can they do? One of the things that I've seen happen in the industry is that when you see somebody who's really good, irrespective of where he is in, the profile sticks in your mind. And a lot of the hiring happens through word of mouth and references. And if you are in one of those kind of a roles, I think it's essential that you build the relationship with the private equities that you're working with. You share your point of views with them. You use the opportunities whenever you get the time to interact to share your point of views so much more. And maybe just informally catch up with people and understand what is it that they did, what was the additional things that the buy side did before they made a view and they took the transaction forward or did not take the transaction forward, and keep looking out for opportunities, and that should come their way.
Right.
Got it. And Arjun, the other thing that we wanted to kind of test was that when you look at the starting roles for a track position in a fund, increasingly that obviously is more competitive than it used to be, also because of the number of people doing pre-MBA roles, right? More and more funds have pre-MBA programs now. And so once those candidates kind of do their MBA, a lot of them want to come back. So when one is thinking about like looking at track roles in funds, what is the perspective that funds have when considering somebody, say, who has done banking post MBA versus somebody who's done private equity pre-MBA and now wants to come back? So how do you evaluate candidates from that? And then working backwards, how should candidates, try to tailor it to just maybe increase their chances just a tad bit when they are recruiting for track roles?
Sure. I think pre-MBA roles didn't really exist when I started off. I think in my view, it's probably one of the best things that has happened, because it's a forum where both the candidate and the firm can evaluate each other and see the fit, right? And given a choice, I would urge everyone to try and take up or do this pre-MBA kind of a role. You get a full ringside view of what happens in private equity, and the firm also gets to see you at your best. That said, there is always a need. Our industry in India is growing so fast that there will always be a need for people at the early stage who are from different fields as well. And that need also arises because you are looking for some sort of specialization or some sort of specific focus, or somebody who's worked in a particular transaction or in a particular sector a lot. So, for example, when I look back at my own firm and some of the people we've hired, these have been because, the guy had immense experience in TMT, or the guy had immense experience in financial services. And may not be at a beginning level, but somewhat at a mid-senior level or a mid-junior level, you've had those kind of openings come through as well. And I think what else can someone who's probably graduating from a B school, if he's not had a pre-MBA experience, do to get into private equity? I've not seen a lot of private equity hiring happen straight through campuses. One, of course, there is a campus opportunity that you have. But otherwise as well, irrespective of where you start off, it's always useful to just get in touch with the few funds that you think are doing the kind of deals that you're doing, and see who you can just catch up with informally. People are always happy to chat, happy to guide you informally. It's just helpful to be in the network of a few more people and let them know that you're keen. And that always registers in people's mind, and they call you back whenever there's something there.
Yeah. And just what do you really want to see in terms of like the developmental journey of an analyst once they join your firm?
Yes. So what happens with many people is they are very good because they've been filtered and screened and all of that. So they're very good with what they do, and they come out and they start doing a lot, and they start doing it very well. One of the biggest things I've told everyone I work with is, your fundamental job is actually not doing. Doing is important. Doing is necessary. Doing is hygiene, and you should be good at it. But how do you get to the next stage and how do you get there faster is if you actually set aside time for yourselves to also think. So you should hone your skills, hard skills, to an extent that you're able to finish everything you have to do. And then you also have some time left for yourselves to think of the so what of everything you've done, and think of where it is being applied. What is your immediate senior in the deal doing? How can you fill into his shoes? And the moment you start doing that, you'll just suddenly realize that your contribution has gone up a lot more. You are at a lot more ease. You are also anticipating what is coming through next, and therefore so much more prepared, and your game just moves to another level. That's one of the things that I've always told and even applied to myself all these years. And that's certainly something that everybody should keep in mind, that the job is not to do. For example, if I ask someone to put together a comps table, the idea is not to just give me numbers, right? The idea is to just tell me your view on what is the comp table. Why are some of these companies trading higher, companies trading lower? And more often than not, which transaction it is for. Then therefore, what is your view on this transaction? Right? What is it that we should think of as a valuation? I think if you're able to therefore do a little more and more of that, you just get a lot more engaged and involved in the situation as well.
So there's just another question that we wanted to lob in was, for folks who are still a few years away from their investing interviews and maybe they're just starting off or in business school, what are perhaps the 2 or 3 things that you would advise they pick up or, continue to learn in order to better prepare themselves when they're finally across the table interviewing?
Yeah, see, firstly, if you're 2-3 years away, then you're doing something, which is very important as well. So probably do that with full focus, because it's equally important that you get your grades in whatever stream that you're finishing off and have a good academic track record to show. And it also shows your seriousness and commitment to what you've gotten into. But even otherwise, investing is a kind of skill where it takes a lot of commercial sense. It just takes a lot of knowing what is happening around the world. Today, there are just avenues for people to read up on that or stay in touch through different medium. And so maybe have 1 or 2 areas where you've taken a view, right? You take a view and track it for those 2-3 years and see how it is done and see for yourselves and what you got right and what you got wrong. There is no right or wrong, but at least what aspects you thought through and what aspects you did not think through. And what can you think at a greater depth? And so 2 years out or 3 years out, when you're talking to somebody in an interview, at least you're able to present it out there and show your inclination or show your desire to be in the space, right? That is very helpful, certainly.
Yeah. Arjun, and just one last question to close this segment out, which is if someone wants to use the skills that they have developed in private equity and sort of branch out to other sectors or other fields, what are some of the main exit routes?
Sure. I've seen a few people take up operating roles at early stage companies. See, one of the best things that's happening today is that every business is being thought through from first principles again, right? There is pretty much every business is up for challenge. And so a lot of the new age companies have a lot of positions where people who are not otherwise from the industry are coming and filling in those roles. The CFO of delivery was an engineer with no formal finance training or education. Right. And once this happens, everything really then boils down to just common sense and being able to apply your mind and the experience of seeing things being built from first principles. Right? And so with that, I think a lot of roles will open up. Certainly in early stage companies, a lot of these companies that are coming up will look to roll up younger companies as they build capabilities beyond what they started off with. And so M&A roles should be of huge value. Typically also people who run businesses don't think of M&A and don't think of acquisition opportunities in the same way that you as a private equity investor can think of. So certainly I think corporate finance and M&A is one area where I think there is a lot of opportunity. If you are from the private equity space, that's one area where I think people can find good opportunities.
Right. And Arjun, while we had you, we wanted to just pick your brain on a couple of questions related to the financial services sector, given your vast experience in that. So I think the first question was just along the lines of, we've seen a number of trends probably play out over the last 5-7 years, which, for example, the rise of MSME and NBFCs, the continued rise of the private general insurance players, and a lot of other trends. What are 2-3 trends that you are thinking will play out in the next 5 to 10 years?
Sure. One of the things with financial services is that it's not a product that people aspire to consume or people consume, right? It's just a byproduct of something else that people are consuming or something else that's happening as an activity. And financial services always resided in specific institutions, which are known as financial services institutions, which are regulated, which look and feel in a certain way. As we think of what's happening today, with financial technologies and the overall changes in ecosystem, and you try and imagine what can happen in the future, a lot of what we consume as financial services could just get embedded within what you do, right? And so a lot more institutions and a lot more organizations can actually offer financial services, or your decision on financial services could actually get embedded within your decision of making a certain purchase or doing a certain transaction, and you wouldn't even see what is happening behind it in terms of the financial product that is being attached with it. And so the customer can be targeted real time at any point in time through so many different mediums, right? Unlike traditionally when you had to go and engage with a financial institution and get things done. And that can, I think, massively change the landscape, be it with lending products or be it with your savings products and insurance in a massive way. And there are already signs of that happening. That's one clear trend for sure. And like you said, there have been a rise of MSME companies, but if you look back in the last 5 years, there haven't been as many NBFC opportunities which have come up, which are doing the business in the same old traditional way, right? So that's also another sign that things are certainly changing.
Yeah. And one of the spaces that we've seen a lot of new entrants in is the whole broking and distribution space, particularly on the stocks and mutual fund side. Right. How are you sort of maybe just thinking of how the industry landscape will look maybe a couple years down the line with the newer players as well as the traditional players?
See, broking is a highly pro-cyclical business. And I've had my own journey of seeing broking firms for the last 12 years, where they were probably darlings of the market in 2005, 6, 7 to being the most hated companies in 2011, 12. And now again, you have so many brokers who are actually doing so well. I think this is an industry where you have to believe that, as cycles come and go within a particular economy, brokers will look good and bad. But then if you sleep and wake up 10 years hence, there would be a lot of brokers who would have actually made big businesses and valuable businesses. That said, as such, a lot of these broking companies have also realized that just broking is not going to be enough. They will have to do something more. And that's true for probably a lot of retail financial services businesses. I think across the board, people have realized that now, if you have a customer, you have the ability to offer him everything. So broking is probably ending up as being the medium to acquire people in this kind of a market. But a lot of these companies are moving forward and trying to see what else they can do to just encompass the customer and keep them entirely with them. Again, very similar to what happened in traditional banking. If you had a customer with 3 relationships, he stuck to you for life. If you had a customer with 2 relationships, the average life is shorter. If you have 1 relationship, the life is much, much shorter. And I think that's the same learning that will get into these new age broking businesses. And you will see a lot of them, wanting to do other things with their customers and strengthen their relationship with the customers to retain them.
Got it. And just the last one on the sector portion, which is that you've seen like banks particularly go really deep into like retail lending as part of a whole rebalancing exercise that they're taking. And a lot of those products that they're starting to move into have traditionally been the focus of NBFCs and some of the most successful places where NBFCs have played. Do you think NBFCs have to adopt a newer strategy as banks come in to those segments, or how do you see that whole dynamic playing out?
I think my personal belief is that whether you're a bank or NBFC, definitionally will not probably be the differentiator, as much as whether you're really able to understand the customer and catch him at the point of time where he is most prone to make a decision or most prone to buying your financial service product. And there are NBFCs who do that very well. There are banks who do that very well and very poorly as well. I think for a good period of time, banks by definition will have the advantage of the cost of funds, and therefore they have greater chance to fail before they succeed, whereas NBFCs probably have so much lesser time to succeed. But then I think there will be NBFCs who will make it as well. And similarly, on the liability side, you're seeing a lot of disruption where people are now coming and saying, you could have your relationship with a Kotak or an SBI or an ICICI, but I will originate the customer, and the customer will be on my app, and I will control the experience of the customer. And so everything, even on that side, is really up for rethinking. And the regulator is getting a lot more open to thinking and discussing about newer licenses. And so let's see, what happens there. And honestly, today, when I think of it as a liability provider, you could actually have an app where you're providing liabilities and just putting the money in a liquid fund and replicating what a savings account can do. Right. And if that's a solution that a fintech is able to pioneer and scale up in a big way, there's no reason why they can't build the same cost of funds advantage that a bank has and build the same trust and credibility with customers as well as with the regulator to be then able to offer everything that a bank does. So I think the differentiation of the future will not be so much a license as much as the capabilities that you build in the company itself.
Got it. And I think, Arjun, like just the last segment that we wanted to touch, and we got a few messages, etc. also. This is slightly more technical, but also very specific and peculiar to financial services. We couldn't think of anyone else who would be better placed to answer or help us think through some of these things. So just 2-3 quick questions on this front. The first one is, we often hear a lot about pre-money and post-money valuations for FS companies. And when you also model some of these businesses, then the post-money valuation that you look at can have a significant impact on your returns if you kind of putting in primary capital. So can you just explain like why is it that we kind of look pre-money and post-money specifically in FS and not so much in other, say like a kind of traditional consumer business or other kind of businesses, and what's really the thinking behind it?
Sure. I think you're referring to pre-money and post-money price to book. There's really no pre-money price, post-money price to earnings, so to say, except I think the concept here is, back in those days when I started off, the way we used to do this was, and this was a pretty clear, I think a lot of people did in the market, that whenever a financial services company announced a fundraise, the price would pop up a bit. And people would say that's because he's raising capital and the post-money price to book is going to fall. And so therefore you buy it up. I think the idea here is that, there are companies which are growing fairly well. And usually with younger companies, with smaller companies, there is a big delta between the pre-money and post-money price to book. With more mature companies, the delta is not that much. And so really you look at whether you talk of pre or post-money price to book, it really doesn't matter. But with young companies, when you give them a lot of capital and they're able to grow fast enough in a manner that they're actually able to deploy that entire capital out, then you can think of the price to book as post-money. You're saying a company has 100 crores in net worth and maybe 500 crores in AUM, but it has the capability to soon become a 1,500 crore AUM company, right? And maybe have 400 crores in net worth. Then I will value that company as a company with a 400 crores net worth and the book value per share, which is corresponding to what is the book value post the transaction. And that's a math that you do often to kind of sell the transaction to say that it is not as expensive on a post-money price to book. But where you get it wrong often is that not all the companies end up going from a 500 crore to a 1,500 crore AUM without hitting a speed breaker or without having credit costs, right? And that's the most important thing to keep in mind. The other important thing that you will normally see in financial services is people don't talk of price to AUM. And over time, what I've seen is leverage ratios have been going down. And when you compare transactions on a price to AUM basis, because AUM is ultimately what you build, everything else is just capital structure, you see a wide variance in the market as well. And it's important to therefore see that, because your price to AUM is also telling you how levered you could be and how much more you need to grow to build that AUM, which is meaningful.
Actually, you also touched upon briefly on the next question that we had, which was, people also, when evaluating or comparing different companies, you sometimes look at ROA and you look at ROE. And for a lot of younger companies which have not taken as much leverage as some of the mature companies in that sector have, people tend to look at ROAs and therefore the potential ROE. Whereas mature companies, even with lower ROAs and more leverage, look at ROEs. So how do you kind of, I know the difference is leverage as you were mentioning, right. But when you evaluate businesses and compare them like to like, and then how do you think about the ROA versus the ROE, like the implications on valuations and your decisions, etc.?
Sure. Look, I mean, ROA and ROE is really a function of everything that is in the company, right? It's your mature branches, it's your early branches, everything is baking into it. The ideal way to actually make a final decision is to really see the unit economics at a cohort level and see what it looks when you have a scaled up business. But that said, ROA is also a function of your cost of funds, not just leverage. What happens with a lot of young companies and young entrepreneurs is that when you start building off a business, you are borrowing at rates which are not really reflective of what it can be at scale. And so when you talk of an ROA of a company which is borrowing at price, you're not really doing justice, because the same asset built with the balance sheet of a different lender can have a significantly higher ROA. Right. So that's the other thing that you need to keep in mind when you think of ROA and ROE of businesses. Fundamentally, the way to do this is you strip a loan, you take a loan out and you see the economics of the loan, and then you layer up your operating costs and then, of course, add your credit costs and see what the steady state profitability of the business is and what ROAs you make. ROA to ROE is actually, for me, it's not a function of the company as much as it is a function of the segment. A gold loan versus a housing loan versus an unsecured personal loan will have different leverages at which they'll operate. And I would apply those leverages to it rather than what the company is at, because that leverage can always change depending on who's the new investor, who's the new shareholder, what is the funding the company has raised, what scale the company is, and how much vintage the company has had. And those things will solve for themselves, right? Those are, for me, the more easily solvable problems. The harder problem to solve, or the two hardest problem to solve, the hardest problem is one of building the assets and building good quality assets with growth. The second hardest problem is of getting the right liabilities. And once these are in place, I think the ROA, ROE math has a lot of flex to play around, and there's a lot of jugglery you can do to show good as bad or bad as good, whichever way you want.
Yeah, Arjun, I think we've kept you for really long. And thanks so much. I think we covered a whole host of topics. That was really helpful for us, and I'm sure it will be for the viewers as well. So yeah, thanks a lot for taking the time out.
No, I'm glad, and I'll be very happy if you and the people who listen to this find it useful.
Yeah. Thank you so much, Arjun. Really appreciate it.
Thanks, folks. Thanks, Aman. Thanks, Val. See you. Bye.
Hey, thanks a lot for watching the video. Hope you found it useful and also got a few actionable insights.
Check out our website and join the mailing list for regular content. Do spread the word and share it with anyone else you think might find this useful.